I think the biggest risk to markets is central banks decide to worry about inflation. So at the moment we've got higher and increasing inflation. I think hyperinflation's right out there in terms of extremes. That's something that happens to developing nations with a lot of foreign debt and a currency collapse, like Zimbabwe or Argentina. You're not going to get hyperinflation on a global level like that. It's a bit more fringe, sort of too much money printing. But you're certainly seeing higher inflation. At the moment, central banks are quite calm and tolerating it because they are focusing on those transitory elements that eventually supply chains will normalise. But the risk is that the big deflationary forces that we've had in the past, globalisation, China unleashing capital and low-cost workers, the whole world taking their supply chains, driving those efficiencies, that's all been very deflationary, and it's meant over the last 20 or 30 years, whenever the economy slowed down a bit, inflation's really dropped and it's been slow to come back. The risk is now that people are pushing back against China in terms of raising tariffs, and they themselves, their workforce is starting to shrink and their inflation's picking up. So globalisation's pulling back. Firms, because of those supply chain disruptions, are looking to hold more inventories. So we're not seeing necessarily that big deflationary force, which means that inflation, if it persists, it gets embedded in wages a little bit more, that central banks might be making a policy error, they might be too tolerant, and when they come back and go, hang on, it's not just going away by itself, we need to do something about it. That's the risk for markets. That's not going to happen next week or next month. It's going to take a little while. So 2022 is going to be an interesting year where we're probably going to see inflation picking up, becoming higher. The market will start worrying about what the central bank's going to do, but you'll probably see central banks staying pretty calm, at least for a while, until there's evidence that it's really feeding through into wage growth and it's something they need to actually act upon. And that's the real danger for markets, because central banks have probably overstimulated. There's so much leverage in the world and on all different levels, and it's really pumped up asset prices. If that's taken away in a forceful manner, that's more your Armageddon scenario for markets. We're getting a hard landing, economic recessions, big falls in stock markets and those sort of things. There's so many lags in these things that they start raising cash rates and inflation just keeps accelerating and keeps going up. So they've got to keep raising. It's a bit like boiling a frog. And that's what happened back in the 90s, the late 80s. It led to the 90s recession. That it started trying to fight inflation, but the only way you can fight inflation at that level is to actually cause a recession, put some slack back into labour markets, get inflation down. So achieving a soft landing is going to be very difficult, and it's even more difficult now because there's so much leverage in the world. It won't take as much of a rate rise to actually trigger some financial distress and potentially a hard landing. So central banks are really walking a tightrope, and all their stimulus of the last 20 or 30 years has meant that tightrope's become narrower and longer. So it's a tough job. I think the cash rate going from 0% in most countries around the world, or close enough to it, to above 2% with the current amount of leverage in the world, will start to cause a bit of distress. We'll possibly see that play out in 2023. We always, in our portfolio positioning, try and achieve a degree of balance and not take too much of a view that's really just state dependent, because as we were just discussing, the inflation outlook is very uncertain. How central banks react is going to be uncertain, and the timeframes are uncertain as well. And the market will quite likely swing between those uncertainties and create a lot of volatility and rotation. And the winners and losers can be complete opposites. So in inflation's under control, central banks are relaxed, then growth stocks do really well and everything else. But if you get into an environment of they're going to tighten, then you want short duration and maybe cyclicals. Or if it's going to be a hard landing, then really defensives like cash proxies and the like. So they're wildly different portfolios. So we don't try and make that call. We just try and focus on individual companies and what they're doing and be really balanced between those scenarios. So we run our portfolio, we look at 8 broad groupings of stocks, and we try and be neutral to those, but take some really interesting stock positions within those groups that can add value to the overall portfolio. I feel bullish and bearish, and I change my mind several times a day. It's really hard to call at the moment. Bullish in the sense that we've had an amazing recovery from, in an economic sense. In a health sense, it's actually been a pretty good recovery as well from a global pandemic that at one stage threatened to unleash financial Armageddon and something worse than the Great Depression. There's 20% unemployment in a lot of developed countries around the world. So the way that we've been able to actually, good policy response, recover from that, the impact of vaccines and everything in terms of getting people out, economies moving again is really positive. And there's a lot of positive stimulus still to work the way through. So, new infrastructure bill in the US. Australia's finally happy to run budget deficits and spend big for a while. Interest rates are really low, so that's all supportive of earnings. We see record earnings coming through companies everywhere. One of the interesting things about this dynamic, the flip side of the coin of inflation, is what's driving inflation is companies putting prices up because they can, and everyone else is as well. So there's a bit of a psychology shift there. You're seeing margins expand for companies driving profits. So that's a pretty good backdrop. But we're at sort of stretched record valuation, and if some of that stimulus starts getting taken away, it leaves the market vulnerable. So yeah, we're feeling bullish until the party stops. So you've got to keep an eye out for when central banks are going to take that punch bowl away from the party. But it seems probably a little bit towards at least the second half of next year.